Good morning, everybody, or for some of you, good afternoon. This is Stuart Ellis, Chief Executive Officer of Charter School Capital, and we're here with you this morning for our webinar, New Year, New Charter School Facilities Knowledge. The program today will run about an hour, and all the materials are available for download afterwards, including the written materials, and our talk today with Larry Rieder, Charter School Property Solutions, will be recorded and is also available for download after the session today. So we thank you all for joining us today. We're excited about the content we have to share and about my co-leader today, Larry, who is an expert with years of history in the charter school space. And with that, I'm going to let you know that as we go through things today, if you have any questions or want us to reiterate, enhance, or describe in more detail anything that we cover, please utilize the GoToWebinar functions to send questions over to us, and we'll try to address them as we go throughout the presentation. With that said, I want to introduce Larry, the president of Charter School Property Solutions, and say good morning.
Good morning, Stuart.
All right. Larry, tell us a little about yourself.
Yes. Okay. So I started the company in 2006 completely by accident. I had a building in Albuquerque, New Mexico that I was running a separate business, closed it down after about 18 months. It was a retail business, my first venture into retail, and I put the property back on the investment market, and lo and behold, somebody walked in, a woman who was running a local charter school, and she said, I want to lease your building. And I run a charter school. And I had no idea what a charter school was at the time. But to make a long story short, I ended up investing a little over $1 million in retrofitting the building. It was a former parking garage. And so she became my first employee about a year later. And between her content knowledge and my experience in the real estate business, it was a great partnership. And so from 2006 on, we have been developing real estate properties for charter schools around the country. We have our own private equity, as well as we use and evaluate other lenders, such as Charter School Capital. And so that's what we've done since 2006.
Larry, how many charter schools or charter school projects have you done approximately over the last 10 years?
We've done in excess of 15 around the country. Everything from build-to-suits to renovating existing properties into educational space.
Well, with that as background, for those of you who are not familiar with our background or my background, I founded Charter School Capital also in 2006, funding our first school in 2007. And while our history is that primarily or initially providing working capital and growth capital to charter schools, a little over 3 years ago, we expanded into long-term financing for schools with on the real estate and facility side. During our time, we've funded over 550 charter schools, now in 15 states, and supporting 650,000 plus students. And we've invested over $1.5 billion today in charters, in charter school growth, stability, and other services to support the services most of you provide directly to students across the country. Larry's expertise and experience, given his longevity in the market and the breadth of projects that he's engaged in, makes him great for a discussion like this. We're going to talk about issues around your facilities development, financing, and growth and expansion. Things we're going to cover today. We'll give you an overview and an update on what's going on in the financial and facilities markets around the country from our perspective. We'll talk a little bit about the construct or contrast between your facilities dreams and the realities of managing to some budget. We'll compare different funding structures so you have some insight into what might work for your specific situation, what alternatives are out there. For any set of alternatives, we'll talk about funding approval and what it takes to qualify for financing in the market. A few insights around project execution and timing, and then by the time we get to the tail end of this, we'll hopefully have covered most of your questions, but to the extent there are more, we add in a few other bottom line insights. As noted at the bottom of this page, the presentation is available to download afterwards, including a recording of the webinar at charterschoolcapital.org/webinars. So click there, and at the tail end, you'll also get insights into how to contact Larry directly or us. That said, to the extent you hear some pitter-patter of little feet in the background, that is the rain in Portland, Oregon this morning. So hopefully it won't be too bothersome, but we will, while Larry's talking, to the extent it is too noisy, I'll go on and off mute so that you guys can really focus on what he has to say. That said, let's roll through the material. And with that, let's talk about the market. So at a high level, some things to keep in mind about what's going on for charter school funding and financing today on the real estate and facility side. The first is one of the biggest obstacles to growth for any specific school or for charters nationwide is the constraints around facilities and facilities access. Recent update from the National Alliance says that there are now more than 3 million charter school students nationwide, but over 1 million kids still on waiting lists just to get into those 7,000 charters. Many schools complain of having suboptimal facilities and an inability to expand or enhance those facilities to suit their programs due to lack of capital availability or other constraints. But today, there are more financing options available for charter expansion or enhancement of facilities than ever before. That said, it doesn't mean that it's easy to get it or that there aren't disruptions. And although charter school financing options have expanded significantly in the recent years, financial markets have been recently disrupted, particularly due to the recent presidential election, and global markets have really kind of stopped short and are quite uncertain about what's going to happen. As a result, a lot of capital that was flowing into the charter school space and other arenas has stopped and is sitting on the sidelines. As a result of actions by the Federal Reserve over the last year and a half and the election, long-term and short-term rates have been rising quite rapidly. As such, to the extent you have opportunities to refinance or lock in some kind of long-term financing with predictable and or fixed rates, that kind of program could be beneficial right now to the extent you have access to it. That said, the turbulence in the market and inconsistency do make for some uncertainty, and as you think about projects you're engaging in right now or plans you have for the future, that really needs to be taken into consideration. Buying land, for instance, with the school's reserves or some kind of short-term financing without having an entire project funded in its entirety with committed capital could be dangerous, because you could end up getting partway through something and be constrained. So make sure that's something you take into account. And finally, another thing we're going to cover today as we go through things is the alternatives for your specific situation. They vary depending on what kind of organization you are, whether you're a single corporation CMO with multiple charters, or an EMO advising and backing multiple charters in a network of different corporations, or an individual school just serving your direct local community, you have very different alternatives available, whether you're looking at refinancing or expansion, or the different types of financing, whether it's a long-term lease, bank financing, or bond financing, or other alternatives that really generally fit into those groups. If you're a school with 100 kids in year one, you have very different alternatives than if you're a school with 1,000 kids as part of a 20-school network operating in your 10th year. So obviously, things vary. Before we move on, Larry, any words of wisdom for what you're seeing in the current market, given alternatives out there and dynamics?
Yeah, I think Stuart, for those of you on this call that have been around for a while, you remember 5 years ago, 6 years ago, when the bond market dried up completely, and you couldn't do a bond. We've also seen rates over 12%. Now we're seeing rates that were 6 months ago, 9 months ago. Alliance for College Readiness did a 3% fixed deal for 32 years, and now we're seeing those same bonds at 5.25, 5.5, 5.75. So, the rates are definitely up, and it's kind of unpredictable as to what's going to happen. Trump is talking about a tax rate reduction, which is going to make it less favorable for investors to look at tax-free bonds. Some of the banks out there that were doing charter school deals now aren't. We've also seen some turmoil on a local level. Some states where the state operating budgets have been in trouble. We've seen that in Pennsylvania. We've seen it in California. We're seeing it now in New Mexico, and that's all affecting charter school funding. So these are going to be interesting times.
Well, with that as a backdrop, let's talk a little bit about the contrast between what is required or what you desire and what you can afford. Both sides of this equation are important to schools. One question we're going to go into a little more detail around is what can you afford, and it's really based on your existing reserves, an ongoing percent of revenue that you want to commit to supporting your program from a facility standpoint, fundraising, whether it's public contributions, grants, et cetera, or private donations, and the alternatives from a financing standpoint that are available to you. We're going to get into all that in much more detail, but that has to be contrasted with what's required to support your academic mission, your growth plans overall for attendance and enrollment, any specialty requirements you have if you're offering a particular program, maybe targeted at special ed kids or something like that, or you want to do an athletic program or a drama and arts program. You'll have different facilities requirements depending on those, and any local considerations, which may have to do with funding available or zoning requirements or anything like that to serve your specific community. Larry, thoughts or examples from your experience about where schools can either run into trouble or opportunities in thinking about these things?
Sure. We see schools that, especially in the early growth years, where they may be operating out of a school district facility or a church or portables. Now all of a sudden, this is their foray into the market for a permanent space. And a lot of times we see schools that aren't necessarily prepared or that have sticker shock, because now all of a sudden they've gone from a very, very cheap facility cost to something that's going to be maybe 3 to 4 times what they were paying before. So we see a lot of that, Stuart. When we talk about local considerations, because we are crossing borders all the time, every state is really unique in the sense that it has different zoning laws, it has different funding requirements. As an example, schools in New Mexico can only sign 1-year leases. So it makes it tough from a financing standpoint to do a deal in New Mexico. In Georgia, for example, charter schools don't have any appeal process. So from a lender's perspective, it's kind of interesting, because if a school gets into any kind of trouble with its authorizer and it its charter revoked, that charter school has no appeal process. Louisiana, the authority right now in Louisiana will not approve a bond. So charter schools in Louisiana have to look at other financing sources besides bonds because they won't do a bond. We're finding more and more that from a zoning and an entitlement process, it's becoming tougher and tougher. For example, we represent a charter school outside of Philadelphia right now. We've been to the local zoning board on 2 different properties, and we've been rejected twice. Now, this charter school is really, they're really potentially exposed to having to close their doors because we can't find a facility that they can move into, and their existing landlord won't renew their lease. So, you know, there's a lot of challenges out there for charter schools. It's not easy when it comes to facilities.
All right. Well, let's ask the question: if you have the space or you found a facility, how much can you afford? This chart that we're looking at, you see on page 9, across the horizontal axis, you see annual school revenue, the dollars that are income coming to your school each year associated with the students you serve. And beginning at the far left, where all 3 of these lines, green, gray, and gold, begin, that's at startup or at 0. And the chart extends out to $10 million a year. Regardless of the number of students, from an affordability standpoint, it's about what is the income coming into your organization. On the vertical axis, you can see what's the potential project budget. And this is a function of your revenue and what percentage of that revenue you want to commit to supporting your facilities. Obviously, every dollar you spend on the building, land, space, et cetera, is $1 less that you have to spend on teachers or administrative aspects or curriculum. So these rules of thumb, what you see in these the 3 different lines are the gold line or the lower line that heads across assumes you want to spend 10% on facilities, 10% of your annual income on facilities. The green line is at 20% and the gray line is at 15%. This range gives a pretty good framework for what we see across the country, and depending on the competitive environment and the underwriting requirements of different financial institutions that may be supporting you with capital, experience suggests that you really are going to have a very hard time qualifying for anything over 20%. And in that example, I say that because our experience is it's very hard to be competitive long term if you're spending more than 20% of your money per year on the building and the space, as opposed to on the program itself. It doesn't mean you can't have, you know, like 1 year early on in the financing, you know, be over 20%, but you're going to have a hard time even getting capital that, if you're trying to sustain something at that level, because your program is unlikely to be sustainable long term. On the other hand, it's pretty rare to see, there are some states where real estate and facilities costs are so low relative to the revenue or income per student paid by the state, but it's still rare to see facilities cost as a percentage of revenue at below 10%. It's great if you can get it, but you're going with typically a scaled down facility and in pretty rare locales. So this is a good range, and with these as rules of thumb, you make a strategic decision yourself at your school level or your board to decide where you want to be in this range. But if you were spending 20% of your income on and you were $6 million a year in annual revenue, that says you can afford a $12 million approximately property. Now, what this chart has already done is taken into consideration the current market costs associated with either debt service on a bond, including the interest, transaction costs, and amortization, or typical long-term lease payments, in rent or other forms of financing. But what you can see here is if you have $6 million in revenue, at 20%, you could afford a $12 million total project budget. At 10%, it's a $6 million total project budget. That gives you an idea of what you have to work with. It's important to have this framed before you enter into a project so you don't have an architect design plans for you if you're that $6 million a year school, even at full attendance and enrollment. You don't want an architect to build you a $20 million or design a $20 million facility for you. You're simply not going to be able to get that financed and or afford it in the long run. So that this is a framework to think about any of that. Larry, anything you want to add on this particular piece before we go look at the different alternatives that fit in any of these constructs?
Yeah, Stuart, just one quick comment. Obviously, each one of you operates in different states where there's a balance between what state reimbursement you're getting and what the cost of real estate is. You could take a place like Reno, where you have one of the lowest state reimbursements and you have a fairly healthy real estate cost. You shouldn't expect your facility cost to be closer to 10%. Most likely, they're going to be somewhere between 15 to 20%. If you're in Pennsylvania, it's completely inverted. You have a cheap cost of real estate and you have a pretty high reimbursement rate. Therefore, you should be closer to the 10 to 12% rate. So you just know that you have to take that into consideration. What's your state reimbursement and what a real estate costs run in your particular state?
I think California is a good example of a state that definitely is at the very high end in terms of facilities cost as a percentage of revenue, but there are also state subsidies available for locales in urban regions or with high concentration of free and reduced lunch kids. I think today the law is now over 55%. It used to be over 70% free and reduced lunch kids, and those kind of programs exist in many states in different forms. In California, you can get as much as 75% of your lease payments reimbursed by the state through Senate Bill 740, whereas whereas nothing is contributed to a loan or bond structure. With that in mind, let's talk about some of the alternatives that are specific to your unique situation. So if you look at this page for a moment, what you see on this chart is, again, looking at the horizontal axis and the labeling at the bottom. If you move from left to right, you're moving from pure startup, year zero, to 10 years plus or maturity. So as you move from left to right across this chart, you're thinking we have more and more years of existence. On the vertical axis, small to large, I know that's could be somewhat big, but frankly, it's around the size of the financing, not the size of your school or anything like that, but the project itself. And then what's in these four quadrants is the range or types of options that are going to typically be available to your school, depending on where you fit on this maturity spectrum and size of financing spectrum. And key breakpoints here are noted in the middle. At the top of the chart, you can see the primary maturity metric that triggers other available options is post your first charter renewal. So the bond market, for instance, which is available for larger projects and more mature schools, typically won't even consider looking at a bond for a school that hasn't had a charter renewal. It isn't that there's nobody out there that will do it or will think about it or look at it, but you're really looking at, they're looking for some credit, and you either need to be part of a CMO or EMO that has many years of experience and broader credit enhancement you can provide, or you must have achieved at least one charter renewal. On the size of deal piece, breakpoint is really typically north of 10 million, though some bond brokers will sit and talk about doing a deal in the 7 to 10 range. But below that range of $7 to $10 million, you really don't either have the option of going to the bond market because it's just too small a deal for them to bother with, or alternatively, frankly, because the transaction costs and pain and suffering associated with it make it not worth it. Even if you could get the lowest rate possible, you might be spending 20 to, on a smaller deal, as much as 40% of the total financing might be dedicated just to the transaction costs associated with financing rather than to the building. And so as a result, if you're a small and early stage school, this lower left quadrant is a good place to start. Most schools will go out and get a short-term lease with a landlord with an empty building, or some schools start, in the basement of a church, or utilizing church space part-time or something like that. Today, there are also something that didn't really exist for charters maybe 5 years ago is long-term leases are available. When I say long-term lease, I'm really talking about 20 years or more can be available to charters in most states today. Organizations like ours at Charter School Capital have committed quite a bit of money to the charter school space and are willing to enter into long-term agreements, even for schools that are smaller or earlier stage. As you move up on the chart, in terms of size of transaction, prior to first charter renewal or earlier stage schools, will often be able to get a developer like Larry's organization or others out there who will commit to funding a school that is in its very early stage. Even a startup school or organizations like that with a good management track record can often get financing and an organization who will commit to a school early and really help not just create the facilities, but support the school early on with other services they may need. And again, long-term leases are available there to larger schools, even if they're earlier stage. When we move to the right side of the chart, here again, schools with more maturity will still have an option of long-term lease, but bank financing, particularly for smaller schools, can be available, and there's a question about whether you have the reserves sufficient to support it. But the banks are sometimes willing to support a local charter organization that's been around for a long time and needs, less money, maybe sub $10 million, $5 to $10 million, or even smaller. A bank will support because the school is putting up some of its own money. And then finally, in the upper right-hand quadrant, the most options are available to these organizations that are large deals, typically north of $10 million, and recent update from bond market participants that I've spoken to says that unrated deals now are really need to be, or the bond brokers are looking for them to be north of $15 million for the project size. But in this quadrant, schools that are beyond their first renewal and are north of $10 million tend to have options for the bond market where it begins to become financially viable and people will look at you. Again, long-term leases are available, and the banks still participate here, but the bigger the deal gets, the less likely it is that the bank will be able to fund directly a charter organization. They will prefer to deal with an organization like Charter School Capital or a developer like Larry's group at Charter School Property Solutions, or they may participate as part of a bond, but they will typically not want to deal directly with the school. So let me pause and say, Larry, thoughts on any of these various options or how schools can navigate this? This is really about where the school fits itself and therefore kind of what options are available. We're going to talk about the pros and cons of each of these options.
Sure, I think it's a great chart, and I think what it does is there's congruency between what the lenders want to see from a school and what a school should really be thinking about in terms of committing to a long-term permanent facility. If you look at this thing, the hardest thing for you, Stuart, and for me is when we get approached by a school that's in its first, second, or third year. And the problem with that is the school is still going through tremendous growth. They may be expanding exponentially during those early years. And so what you have is you have a charter school that hasn't reached stability. It hasn't reached predictability. Even the culture of the school is still taking time to to germinate. You know, some of our clients say that when a kid comes into their system, it sometimes takes 3 or 4 years before their culture takes over and they're actually able to impact a child's academic performance. So it's tough in those early years to make a commitment. Most lenders want to see some stability and some predictability. They'd like to see a school that's gone through 70 or 75% of its growth, so that there isn't this volatility in their financial picture, in their enrollment picture. Once they hit that 5th year, I think it becomes much easier for the school to make permanent facility decisions, and it becomes much easier for banks and lenders to be able to put out that kind of money, knowing that there's a historical track record, there's academic performance, there's good leadership, and there's good trends. So I think this is a great chart for to really see where charter schools are and where lenders are in the marketplace.
Well, as a school, in any of the situations, wherever you are as an organization or wherever you think you're going to be from an enrollment or project size standpoint, as you start looking at these things, there's a number of considerations to keep in mind as you go forward. The first is that there are many financial alternatives out there where the advertisement, if you want to think about it that way, is, you know, wouldn't it be great to own your facilities? And actually, because a lot of us in the education space, because a lot of charter leaders and boards are most familiar with the financing they've done in their lives, which typically is they got a mortgage for their own home. That is, as part of the American dream, the way people think of, ooh, I will own my own home. Ooh, it would be better for us to own our own school. The reality, however, is ownership is an investment. It's an investment in real estate. You put capital in, and then you are subject to the depreciation of the facility, maintenance issues, renovation needs over the long haul, and the rise and fall of the real estate market. However, for a school, which is what we're talking about here, what you really need is control. And that can be accomplished via other financing tools that doesn't necessarily involve an ownership. It may be that ownership is best because, or that ownership is not, so long as you as an organization have control over your site, over the longevity that you can stay there, and over your ability to manage it, update, and modify it. That is really what's most important. And frankly, it's critical, that control is critical to your stability as an organization, your long-term growth, and financial predictability. But ownership is definitely not required. What you really want to look at is evaluating the total dollars you spend, and it's really total dollars you spend each year on having the school facilities available to serve the kids that you're targeting. Again, the market often speaks in terms of percentage rates. So I thought earlier when Larry was mentioning a school that did a 3%-ish bond, or today's, he said, you know, in the 5 to 6 range, and historically bonds were at 12. The interesting thing about that is, depending on the size of the bond, transaction costs can be so high that the effective rate on that could be that even a 5% bond could be north of a 10% effective rate for you overall. You really have to look at the amount of dollars you're spending, because that's what you pay teachers with, is dollars, not percentages. The other thing is that cost isn't just about money. It's about the time it takes and the opportunity that you are missing out on. Management time associated with running the school can be pretty significantly diverted to a long-term fundraising process. Bonds, for example, take 6 to 12 months of very committed time on behalf of a broad range of administrators or your team at the school, involved with a roadshow, presenting to multiple investors, dealing with many brokers. You have the development project going on in advance of getting the bond in place. It can be very cumbersome, and it's a very complex tool. in the end, if you're in your permanent space and you're not going to need to modify it, that could be the best way to finance your organization over the long haul. But bonds have only been available to 12% of charter schools in the country. It is not as common as people think, and they are the bigger projects, bigger schools that are more mature. But in the end, it's not necessarily an ideal solution at any rate. It can be very useful, but today long-term lease rates and other sources of capital, Larry mentioned his private equity backing on many of his projects. Those programs can be very efficient for schools, much more flexible, and allow for staged growth. So you're not locking in all the funding up front and having to pay for it even when you're not using it. And the final note I'd make before turning it over to Larry here is there are structural constraints in the impact on your future options that exist in any of these forms of financing. Having a short-term lease, for instance, well, it leaves question marks maybe beyond the 2 years or 3 years that you might have a lease for about what is the school going to do, and that creates rather huge risk for where are you going to move or what are you going to do, or are you going to be able to negotiate a better deal. As Larry mentioned, the landlord kicking out, one of the schools he's working with, that's very high risk. That said, if you only have 150 kids, at the beginning, having space that serves that for a couple of years might be fine before you expand to a location that's 500 kids and costs 3 or 4 times as much when you can't afford it on a 150 student budget. So those are things you need to think about. The flip side is once you enter into a bond, a bunch of covenants will exist, including things like you can't refi or pay back the bond for 10 years. That's very constraining if you want to grow and expand, because you will not be able to get more capital. So all those things need to be taken into account. We're going to talk about that on the next page about what the trade-offs are as we look at various options. Larry, anything here on high-level considerations before we move to the specifics of each of these structures?
Yeah, Stuart, I think there's, to say that one shoe fits all and that ownership always outrules being a tenant, I think there's so many factors that come into play with a charter school. I mean, some charter schools have cash, so they might look at a credit union financing. They might be able to go to a bank and borrow the money because they can put up to 20%. A lot of our clients don't have the cash. Some projects need to be phased, and so as you said, when you borrow and you do a bond, that bond is fixed, and you really can't look at doing anything with it for the first 10 years. So if you're a charter school that's at 200 kids today, and ultimately you want to be at 600, if you borrow for a bond, you're going to be land banking a lot of space until you grow into that facility and reach full maturity at 600. A lot of times we say to schools, like we did with a school in Minnesota, hey, we'll build out exactly what you need. We'll come back the following year as long as you hit your expansion milestones, and we'll build out more classes. This way you're not carrying more real estate costs as you continue to grow. So a lot of schools we find are looking at a phased project. And so a bond may not be the right way to finance that project. I think it all comes back to what I said before, how much predictability, how much flexibility is a school looking for. And so I think that every situation is unique. Every situation has to be looked at individually. And to simply say that ownership in the pure sense is most compelling, I think that would be a misnomer. I think that from a depreciation standpoint, we know that charter schools are nonprofits, so depreciation really doesn't come into play. I don't think that schools should look at a real estate from an investment standpoint, because they always have to have a facility that they operate out of. So I just think that every situation is unique to itself.
I think that one of the things you just touched on is relevant and pretty important, and that is that one of the reasons that historically or in people's heads they think of real estate as a good investment most people don't really understand financially that the reason real estate is a good investment is because of the tax implications associated with it. There are opportunities to shelter income streams or some of the value because of factors like depreciation, but that doesn't affect and cannot be captured by a nonprofit. There's no benefit to the nonprofit if you own it. On the other hand, some pooled long-term lease programs, those investors can actually benefit from the taxes associated with essentially deferral of those taxes and sheltering that income. As a result, the schools get to take advantage of that if you're dealing with somebody that can take advantage of that, but that requires for-profit providers and that requires a structure where a lease may be involved. But you can accomplish the same things via that vehicle now. If you have a 30-year lease, it's the same as having a 30-year bond in terms of your control, so long as the lease's annual payments are similar to the payments you would have had on the bond. The lease won't require you to pay back the $10 million of principal you borrowed on the bond, but may have rates that feel higher, but on an annual basis, if you're paying the same thing to essentially be there forever, from the school's perspective, you get all the benefits that Larry described. You may not own it at the end of 30 years, but again, what's really the difference so long as you were able to stay the entire time? By the time you get out to 30 years on a bond, if you've paid it off, and most schools end up refining it a few times anyway and starting over, if you had paid it off, you would own a 30-year-old property. Most likely that will require significant renovation by that time that you'll need to update, so you'll be redoing the financing anyway. That said, let's look at the specific options. I'm going to walk through this at a high level, and then I want Larry to dive into any comments on any of these elements here. What you're looking, this is fairly dense in terms of information about financing options. Across the top, you see 4 different core structures, all cash, direct bank financing to your school, the bond market that we've talked about, and long-term leases. Now, there are a lot of different alternatives or names that people will hear in the market, things like new market tax credits or EB-5 funding or rural development funds and a lot of, or CDFIs, getting a loan from the CDFI. All of these are really just subsets of or options within these 4 core structures. The considerations that we're thinking about in this chart, in this example, are listed down the left side. How much cash do you need to put in as a school to close the overall financing? What are your annual costs? And these are estimates, and the details around what's involved there are listed at the bottom, but I'll walk through that. What are the underwriting criteria to get into any of these options and get your full financing? What security interest or collateral do you need to provide to the investors or capital sources in these cases? What does it mean for your long-term growth options to the extent you are going to expand in the future, and any other considerations or challenges that are faced with these core processes? Now, for purposes of this structure, or of this discussion, we used a $7 million project, which, as noted previously, is kind of that borderline cusp at which point, the bond market might become relevant, although, again, most bond providers are really north of 10. You may be able to get something at 7. We tried to use something that was kind of available to all these options, but you can see some of the implications as you go through here. And, of course, it depends on the rates you get and a bunch of other elements, but the assumptions are listed at the bottom. Today, some of these numbers are a little bit outdated, which is that, in some sense, which is long-term leases are, for some markets, less expensive. That's noted here. In some cases, the bond with state subsidies and things may also be less expensive or more expensive. But I think this is a good frame to give you an idea as you compare across solutions. Let's talk about the cash column first very simply. So at a most simplistic level, this just isn't an available option to most schools. Most schools don't have the reserves to support paying for 100% of a project for cash. It's here for a reason. As you look across the options, you need less cash, but you have payments you need to make. In the all-cash scenario, you have all the cash, therefore your annual cost is zero. Of course, you have to maintain the property, but you have to do that in all cases. Your underwriting requirements or the permission you need to get is zero. You don't have to ask anybody. You have the cash, just spend it as you see fit. Your security interest is none. You already own and control it. And your growth options are constrained by how much cash you have in the future. But the big consideration is, do you already have the reserves, or do you have the donations or whatever? And for most schools, they don't have it. And in the words of the CFO of Green Dot, the Chief Financial Officer of Green Dot, Sabrina Ayala, once said on a panel that she and I were sitting at the national conference, she said she had done all of the various options out there for the 20 or 30 schools that they'd funded over the years. And she said she'd done one school with all cash, and she said, actually, that was the worst transaction she'd ever done. They eventually refied the whole thing, and she said she would never do an all-cash deal again. So there was an organization that actually had the money and says that was actually the worst thing they ever did. For a variety of reasons. You don't have, the experts may not be committed the same way. You're really managing the entire thing. And frankly, why would you use all that money you could be spending on your program if somebody else will give it to you or finance it? Why would you use all that money to strengthen your organization and commit it to one building or one facility? As you move across this chart, though, what's the difference between these various pieces? A bank, if it's funding you directly, is typically going to look at giving you 60 to 70% on average of the money. You will have to come up with the other third or so of the funds yourself from reserves. Now, because you're actually contributing some of the money in equity or some of the capital, your costs will tend to be lower for a variety of reasons. One is you actually have fewer dollars or lower dollar amount that you're financing, and the rates direct from a bank tend to be competitive with or lower, around the same as or lower than the bond market. But you need to have typically a minimum of 5 years of in market. That charter renewal we discussed, they will look and compare things to your surplus or the profitability of your school, and then they will take as collateral all the real estate and all of your revenue streams or payments. So once you get a bank loan in place, you will typically not be able to get any additional financing. In terms of growth options, the questions you got to ask yourself is, the bank usually is doing a shorter term deal, typically 5 to 10 years. So the amortization paid off is one of the reasons your annual payments will still be relatively speaking higher, even though you got, a third less or 30 to 40% less money. That said, the fact is, when you go to refinance or you go to look at, hey, what if I can't pay it all off during the 5 to 10 years that was available, you're going to have to refinance down the road, and the question you have to ask yourself is, what will the market be like? If we can't refinance, you're going to have a balloon payment due that could actually put the school under once you get out that far. On the bond side, there you're typically looking at some upfront money, as much as $500,000, that you do for lawyers, architects or design, other elements, ratings, that you have to do even if the bond doesn't ever fund or close. That said, once you get in for a project like this, given the current rates, you're looking at somewhere between $600,000 and $800,000 a year, in part because 100% of the money is financed in the bond market, and that is the great thing about it. But transaction costs tend to be very high. Depending on the size of the transaction, you're typically looking at, for a project like this, you're probably looking at another 20% that you're financing, either in transaction costs, legal fees, the brokerage fees, or interest reserves, which is money you're paying for, but you're not actually using for the school or the project itself. And in terms of growth options down the road, you're going to be constrained by the covenants in the bond and by your ability to expand, because you can't refinance, and the bond locks up, again, all your revenues and all of the real estate. And then the final option to touch on here has become much more prevalent in the market for charter schools over the last 5 years, and that is a long-term lease. Like the bond, it is 100% financing. Unlike the bond, there is little or no upfront cost. The terms on the leases and pricing tend to be competitive with the bond market. Leases are typically available for more often for smaller schools also, and earlier stage schools, because those investors tend to be willing to take more risk. There are no minimums. Academic success, like on all of these, is a critical factor. It tends to be more flexible, and the growth options for your school also tend to be there because you don't have to refinance the entire lease. A landlord like Larry could come in and actually say, oh, you want to add 3 classrooms? Okay, we'll spend a few $100,000 more to put all that in place. No big deal. So you can stage your development and expand the facility in components as you're ready to pay for it. So those kind of these are kind of a framework around the different options, some of the pros and cons. But let me turn it over to Larry to talk about, Larry, your insights on any of these as you think about problems you've run into or benefits of each of these.
Yeah, I think this is a great chart, Stuart. And when we work with a school, we will put them through all of these different options, some of which they may qualify for, some of which they may not qualify for. I'll just go through some of the things that I like and dislike about each. Cash, we normally don't run into any charter schools that are sitting on those kind of cash reserves, so that alternative never really comes, is ever on the table. I like the bank financing because the costs of entry to get that bank financing are very, very low. The interest rates are definitely competitive with bond financing. There's flexibility in the sense that if you needed more money, as long as you're performing and you have a good relationship with your bank, there is a good probability that you can go back and borrow more money. The thing that I don't like about bank financing is the refinance risk. We've gotten proposals from banks. Sometimes they'll go out 10 years, but more likely they're only going to go out 5 or 7 years. And the thing that I don't like is that you're back in the marketplace in 4 to 6 years. Now you've got to figure out, you've got this big balloon coming, and you've got to figure out, how am I going to pay off this loan? Just because that bank was willing to finance the transaction from the get-go doesn't mean that when that loan comes to mature, that they're necessarily going to extend it. The ownership of the bank, the leadership of the bank may have changed. Their philosophy towards charter schools may have changed. And now you're sitting out there sort of naked saying, well, I need to pay off this loan, but I don't have the cash, and now I've got to find another form of financing. Otherwise I'm in trouble. I like bond financing in the sense that it is a 30-year fixed mortgage. The rates are generally pretty darn good, but let's face it, not every charter school out there qualifies. Stuart, as you said, I think only 12 or 13% of all charter schools in the U.S. utilize bond financing. The other thing is, if you need more money, you've got to float another bond. If you have to float another bond, then you have to go through the same upfront costs, all the legal fees, the interest reserve. When you borrow through a bond, your capitalized interest starts immediately, even before you've started construction. So there are pros and cons to the bond. The long-term lease, if you can get a long-term lease and you can get also an option to purchase, I think in many respects, Stuart, that could be the most optimal type of financing for a charter school out there. As you said, it's 100% financing, it's long-term, the costs of entry are very, very low. If you need more money, you can go back to the lender and borrow more money, provided that you're hitting all your milestones. So in many respects, your long-term lease with an option to purchase is a really, really attractive form of financing for charter school.
Well, on the next two pages here on page 14, we've kind of tried to summarize some of the things that you were just talking through with this stoplight chart. And we looked at two different project sizes here. On page 14, a $5 million or smaller project, and on page 15, we'll look at a $20 million project or larger project. And here you see some of the examples. Green light means pretty easy, very likely, you know, kind of good. Red light means either not good relative to the other options or much more difficult or really not available. And so what we're looking at here is, again, against the 5 criteria on the previous page, how much cash is needed for the bond or long-term lease? Very good. For a traditional bank, you got to come up with a big chunk of it, so somewhere in the middle. Annual costs, cheaper on the bank and cash because you're financing very little. On the bond for a $5 million project, actual annual costs end up being very high because the transaction costs are just too high. At $1 to $2 million for transaction costs for really doing any bond, doing a $5 million bond, you just spent you know, as much as 30 or 40% on getting the bond done, and that didn't go into your building, but you're paying for it the whole time. Whereas long-term leases tend to be really beneficial, as Larry talked about. You can see some of these things as you just look at this page, what the benefits are for a smaller project. Then when you move to a larger project, the boxes here highlight the things that change. So just flipping back and forth here, the bank is an option really for smaller programs, but direct bank financing on a project north of 20 million becomes harder. One of the listeners today asked about CDFIs, community development financial institutions, and those organizations are really nonprofit banks providing capital typically from government sources. Conceptually, you would think that they were less expensive, but really they're not necessarily less expensive than a traditional bank, and they really operate very much like a traditional bank. What's key here is that they are willing, or they have somewhat lesser underwriting criteria for schools or programs in the target development regions where their government money becomes relevant. But if you're in one zip code, you might be eligible, and if you're literally, you know, 2 miles away, you might be not eligible. So that's something that has to be considered. The CDFI can advise you about that when you're looking at it. They are an option, but I think the right way to think about CDFI is same as any other community, regional, or national bank. And they will typically be available for things like smaller projects, but it's hard for a CDFI to actually fund typically, you know, $10 to $15 million on an individual project, doing it all by themselves. They may have to group in a few or what have you. And the banks deal with that way also. As you go larger, it tends to be you can't get direct bank financing. On the bond side, things get better as you go to a larger project. So the bonds we just looked at, you see all this red, annual cost, very expensive, underwriting criteria, they're probably not going to do it, security interest, really constraining, growth options. You have to refi it all over again, and you may not even be allowed. When you move to a $20 million plus deal, annual costs get very beneficial, probably best in market. Underwriting is easier because the bond brokers really want to do the bigger deal, and investors do. And growth options, again, if you had a $50 million bond and you went back out and you said, hey, I want to refi it, even if it's before the 10-year period, the investors that are doing it are probably interested in doing it anyway because it's a big deal. Their diligence costs get spread over more dollars. It's easier. The bigger dollar amount, the more flexible the capital markets are. And finally, on the long-term lease, really things remain largely the same. It's good for small and or large, but underwriting criteria get actually easier for more money than for less money because you tend to have other things backing it, or a bigger, longer-term organization that has, you know, more students, more penetration, and more longevity and sustainability. So with that, I'm aware of that as of right now, we're at top of the hour. We're going to run about 10 more minutes. Feel free to stay on if you have to drop off. We understand. You can always go download things later on at charterschoolcapital.org/webinar. Again, you'll get a follow-up email about things, so you'll be able to click on the link and download that. But let's talk about funding approval. How do we qualify for any of this financing, and walk through that, given Larry's and our experience. And I want to note as we get into that at Charter School Capital, funding 550 schools, we've used all of these different tools, represent schools for all of these different tools, and also provide things that real estate financing typically doesn't, which is the working capital that you may need for furniture and fixtures or for computers and technology. And we do those things in conjunction with whatever financing is going on the real estate side. You don't have to use us, of course, for both sides. You can use, us for one and not the other. There are alternatives available for all of these pieces in the market, but understand that as you look at them, everybody's going to be asking the same core set of questions to understand whether you qualify. And those things are, first and most importantly, what is your current and or prospects for enrollment? And everybody wants to see stable and or increasing enrollment. They want to see strong demand in terms of, some people ask for waiting lists, some people look at you expanding grades from an existing base, and they look at the overall market that you're in, the competition versus your academic program and what's going on in the locale. The second thing everybody considers, the school's history or the leadership's history. It's not necessary that you be, a CMO or EMO that's literally launching School 15 or School 55. It could be that you've been a principal or your leadership in your organization has a history of running very successful programs and is now, early on running another one, or people are looking at the actual individual school experience and history. And there it's just an experienced leadership team, proven track record, with one indication of longevity is going to be market-leading academic performance. So how do you compare versus your local peers? On an A through F scale, it isn't necessary that everybody be an A to get funding. But if you're a C school, it's important that as a C school, you're better than, in the environment around you, one would expect to see D's and F's. If you're a C school in an environment where all the competitor schools are A's and B's, investors will have some question about whether or not you're going to be sustainable over the long haul. The third element is the financials. The numbers have to pencil. Everybody is looking to make sure you can afford the facility you're going to be in, not just 1 year, but over the long haul. And that gets back to the stability of your enrollment, but it looks at overall whether it's the lease payments you're paying or the debt service, a combination of interest and principal payback. Really, as we noted, needs to be less than 20% of revenue, and is also contingent on the valuation of the property you're looking at once completed, built out, or acquired, has to be in line with the market. Nobody's going to give you $20 million for a facility that actually is really only worth $10 million in the market. That just isn't realistic. And finally, governance issues, which relate to really two aspects. One is your relationship with your local or with the authorizer, whether that's the state, a local school district, a third-party authorizer, depending on how your state operates. Investors will definitely want to talk to the authorizers, get a sense of how your relationship is with the authorizer, because in the end, if the authorizer relationship is negative, it will be very hard for an investor to believe you're going to last long enough to pay back whatever the financing is if your charter is going to get revoked or non-renewed in 1 or 2 years. The other aspect of governance is the strength or separation and independence of the board versus either the management company or school leadership or what have you. It's definitely something that financial institutions will look at when they look at funding you. These are all things that everybody considers and things you need to be prepared to address in the package with whoever's helping you with the financing. Larry, before we move to the planning and execution, anything you want to add about your experience on these fronts?
Yeah, probably the biggest thing, Stuart, is getting pre-qualified before you start looking at alternatives, before you start engaging with a design firm to start doing plans. I don't know how many times we've run across schools that really don't know what they're capable of borrowing. And I use the analogy with schools. It's like if you're going out and buying a house, what's the first thing you do? You go see your local bank, and they tell you how much you can qualify for, and then you go out and look at houses based on your price range. And a lot of times we see schools that are just out there looking at properties that are too big. They're trying to build out too much space. They haven't really done their homework. They don't know what they're capable of borrowing, and it's going to delay the process. It's going to result in them spending money unnecessarily. I urge all of you guys, when you're starting a project, know how much you're going to qualify for. As Stuart said, nobody's going to lend you more money than you're capable of paying back. And so, that would be my recommendation of the day. Just a couple other minor points. When it comes to a waiting list, if you're at 200, 300 kids today, and you want to be at 700 to 800 kids later on, from a due diligence standpoint, a lender's going to want to make sure that you have strong demand, that you have waiting lists. If you have a waiting list of 20, but your projection shows you're going to be adding 100 kids or 120 kids each year for the next 3 years, they're going to scratch their head and say, why do you think you can meet those demands when you don't have the waiting list behind it? So make sure that your waiting lists and what you're asking for and what you're projecting are all in alignment. That's, I know we're pressed for time, so.
Yeah. There have been a number of questions. We've tried to address them as we go. One of the things that comes up and I think is relevant here is a question's been asked about national default rate and charter school capital's default rate on our 550 schools. And the answer to that is the national default rate, at least in the bond market, was reported by LISC in a report, I think a year ago, that the default rate on bonds was in excess of 5%. I have to go pull the numbers, but it was in the 5 to 6% range of the overall bonds had defaulted. That said, those are bonds that have really failed and written off in some way. And that, although that may sound relatively small, I would say that's a pretty high default rate because that's the top 12% of schools in the entire market, not the 88% that the bond market won't touch. Charter school capital's default rate on the 550 schools that we have funded is actually, it's north of that actually now. Those programs, we have in our history less than a 0.1% default rate. So our default rate actually has approached 0. That said, one of the reasons for that, I think, is not just around our underwriting the way we approach it, because we actually fund a much broader range of schools than the bond market funds. We fund schools, in their first year of operations. We fund schools that are 20 years of operations. But there are a lot of other services that we provide that support the schools during a growth and transition period or help stabilize some of our clients when that's needed. And those services many of those services aren't even charged for. They're just part of the program. Our mission and objective is really to empower charter school leaders to serve the charter school community and students across the country. And in order to do that, that's one of the reasons we've been able to commit long-term capital, fund schools over the long haul. And our very low default rate is one of the reasons that investors are actually attracted to pumping money into the charter school market through charter school capital, because they feel more comfortable and more confident in the credit enhancement we provide and the other support programs. But I think, well, that addresses a question that one of the callers asked today. I think it's important to focus on things Larry just said and this passing the test. Everybody will ask the same set of questions. Everybody is looking for comfort that you'll be around long enough to pay back whatever they're funding. Some organizations have more creative structures, packages, or programs that can allow them to get comfortable at lower threshold levels or earlier stage for you before they're or that they're comfortable providing capital to your organization. I'm going to skip forward and move to the end of this, but a couple of things I want you to be aware are in here around the components of consideration on planning for your facility, and that is you need to plan ahead. The program, any kind of facility move or expansion or financing actually will involve significant amount of effort and engage all aspects of your leadership team at the school. The teachers, there will be site visits, investors want to look at things, you'll have lawyers in there talking to you about different things. These programs, and although there's a varying range of burden, just understand, like moving from your home, packing up everything and moving teachers, students, families, etc., is a big deal. If you're staying at the same facility, but you're just going to expand or renovate, that's a project that you need to build around your program so it doesn't invade. Keep an eye on the market. We just talked about things being disrupted recently and rates and constraints being all over the map. Leaning into something where you're not absolutely certain the capital is already committed by a stable financial provider is important, because you could be taking significant risk. If you have your lease ending in June and you need to open at the new space, across the street or a couple miles away by August, make sure the money's lined up and the development is way ahead of plan before you walk away from your existing program or your existing space. And make sure that you're really prepared as you go through this, talking to other charter school leaders, lining up the financing ahead, and working with a partner like Larry or Charter School Capital or others that have a proven track record of the market of delivering to schools the money and the project and the building so that things are ready, that you don't have some disruption of your academic program. That said, we talked about the bulk of these things. I just want to mention at the back end of this package and available for us to speak to you about if you have an interest are options or organizations that provide long-term leases. There's a state bond program available in some states, particularly, for example, Texas, or there's a new program in Arizona, a refreshed program in California today. And the one thing that I would say about state bonds, everybody is interested in them because they usually come with either some grant or some credit enhancement or some potential for lower rates. But it is a government program. It takes a long time to get into it, and sometimes you can receive an award and then you don't actually get the money. Another example from California, and in fact from Green Dot's direct experience, who we've supported as a client over the years, is they actually got an award from the state for Proposition 1D money. And actually, while it was awarded and they leaned into building the project, they didn't receive the funds for more than 6 years. And it's reimbursement for money they spent. So imagine yourself as you have this really cheap money coming from the state, but you actually need to get funded someplace else in the interim. And while it looked like it would take 6 months, it actually took them more than 6 years. A lot of these government bond programs, first they have to pass in law, and then the state has to decide whether they're going to go out and raise the capital, which they may wait on. And so you could have your award, but not actually get the money. Definitely something to consider and keep in mind. All these other programs.
Stuart, go ahead. Stuart, if I could add just real quick, I like the idea of running parallel tracks. I mean, even if you're pursuing a bond or you're pursuing private equity, it's always good to have a backup, because you just never know when you're going to run into a landmine that's going to impact that form of financing. So my recommendation to schools is let's have more than one alternative running at any given time, because in a lot of cases these schools are really under the gun to get a project done. They might not have the ability to stay where they are, and you just don't want to put your school at risk. The financing market is very, very unpredictable. So make sure you have options. The more options, the more leverage you have in the marketplace.
Great point. I think the last thing I'd say is, as they say in some of the movies, you see some of these fantastic stunts done by professionals. don't try to do this at home. There are experts out in the market and who have done tons of these things and know how to represent charter schools, how to position them with investors, and package things up. Take advantage of those experts and those programs out there to get the most money for the best facility to serve your academic program at the lowest cost with the least amount of time and opportunity burden on your management team. These can be very burdensome processes and projects that have the potential to distract you from your primary mission, which is educating kids. You can find somebody that can commit the capital quickly and will actually manage the effort for you or with you on your behalf. It's a great way to solve this. We're happy to do that. Larry's here, and you're talking to people who have decade-plus experience serving only charter schools. I thank you. Thank you, Larry, for joining me today. Your insights are always impactful, and your track record is unmatched.
Thanks
everybody.
Thanks for the invitation. Appreciate it.
Yeah, it's always great to talk. And thank you, everybody, for joining us today, and for staying on as we ran through things today. Feel free to contact us at the contact information here and download the presentation again at charterschoolcapital.org/webinars. We'd be happy to follow up and help with either directing you to resources that may make sense or serving you directly as we go through things. And with that, we'll close things out and look forward to seeing you on our next webinar. Take care.
Have a great day, everybody. Bye-bye.